Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
This is The Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us here again at Ausbiz. Let's get across what we have seen overnight. Global stocks mostly lower, with European equities and the euro falling in the wake of a trade agreement between the US and the EU. On Wall Street, though, the S&P 500 achieving its sixth straight record closing high, while the Nasdaq also closed at another record in choppy trade. Investors now looking to the policy announcement from the Federal Reserve later this week, as well as a raft of jobs data and the latest earnings results. Checking in on the Mag 7, and it was a positive session led by Tesla, which was up 3%. Shares of data analysis AI firm Palantir fell, with the US Department of Defense testing AI models from Microsoft and OpenAI as it seeks better contracts with providers such as Palantir. Nike shares climbed after JP Morgan upgraded the stock to overweight, saying investors should just buy it. Energy was the best performing S&P sector, buoyed by a jump in oil prices, and in Europe, ASML, the world's largest supplier of computer chip making equipment, gained around 5% on expectations that the sector may be exempted from tariffs. Volkswagen reported a €1.3 billion first half hit from the tariffs and cut its full year sales and profit margin forecasts. And Dutch brewer Heineken welcomed the trade deal and said it was weighing all options to deal with growing tariff challenges long term, including shifting manufacturing. It reported a 7.5% increase in organic operating profit in the first half. Well, US and Chinese economic officials have held talks in Stockholm aimed at resolving the trade war between the two largest economies, seeking to extend a truce by 3 months. With another 90-day extension of a tariff and export control truce, it likely facilitate planning for a potential meeting between President Trump and Chinese President Xi Jinping in late October. Meanwhile, in the wake of that EU trade deal, President Trump, Australia faces the prospect of 15 to 20% tariffs on exports to the United States, with the American leader saying, "We are going to be setting a tariff for essentially the rest of the world, and that's what they're going to pay if you want to do business in the United States." I would say in the range of 15 to 20%, probably one of those two numbers. Well, the Australian government is yet to negotiate with the United States, although last week it dropped a ban on some US beef imports, which had been a long-standing complaint from American trade negotiators. US Treasury yields have risen further as risk sentiment suggested more optimism about global economic outlook as trade deals are finalised. The 10-year rising to 4.42%, and the 2-year was around 3.93%. And the US dollar index was up 1% on the day, while the Aussie has fallen back to 65.2. And Bitcoin is trading at around 118,000 US dollars. Oil prices have surged after the EU-US trade deal and after President Trump threatened Russia with more sanctions if it doesn't end the war with Ukraine within the next 2 weeks. Brent crude futures up around 2.5% at $70 a barrel. Metal prices have taken a tumble, with copper falling 3%, iron ore down more than 2.5% to $99 a tonne, and gold falling to a near 3-week low on an appreciating US dollar and rising risk sentiment. Spot gold down to $3,313 an ounce. Let's get across what's moving US markets. Steve Sosnick joining us from Interactive Brokers. Steve, welcome back. Good to catch up with you again. Let's start with those trade deals. Obviously, the headline being the one struck with the EU. What's the perception in the States? Because outside of the country, it would appear that President Trump is winning this trade war.
Good morning, Andrew. I mean, I don't know how you declare winner or loser. I mean, I guess considering he set the bar at 30% with most countries, and it's now coming in at 15. Sure, that's certainly better than it was, better than feared. On the other hand, we're talking about a country, we had pretty much an average tariff rate of about 1%, between 1 and 2%, I believe. And now that's going to be pretty much 15 or more across the board. So that's got some issues, and I think that still needs to be reckoned with. But in terms of the better than feared mentality, absolutely. But I think another tell is the fact that whatever rally we saw based on the EU deal overnight, our time, was that there was a bit of a bounce in overnight futures, not particularly robust, and then it pretty much faded out once the day started. So that's telling us that it was pretty much either priced in or a sell the news type of event. Either way, I don't think there was a ton of enthusiasm. The dollar was really the only big mover in terms of, reacting to the tariffs and related things to it, as you mentioned, with gold moving on the dollar, et cetera.
So, Steve, what are investors focused on now? It is a big week, it has to be said, data-wise. Also, we have the Fed decision as well. In fact, a number of central banks with their decisions this week. And of course, we are in the midst of earnings with 4 of the Mag 7 reporting this week as well.
Well, you pretty much hit what people are looking for here. It's the biggest week for S&P earnings. Those 4 companies, Meta and Microsoft Wednesday, our time after the close, Apple and Amazon on Thursday after the close, our time. They represent about, whoops, there goes my ring light. They represent about 20% of the S&P 500 weight. And so that would be, that in and of itself bears watching. It's also a huge economic week where we have consumer sentiment, we have GDP, we have core PCE deflator, and we have two sets of consumer confidence numbers. Conference Board Tuesday, Michigan on Friday. So, and by the way, we have payrolls and unemployment on Friday. So there is a lot of news this week. Interestingly, we still see VIX around 15. I guess there's several reasons for it, but one of them could certainly be that there's not a ton of demand for hedging protection right now, even in advance of all this potential news coming down the pipe.
Well, of course, then we have seen the stock market go from strength to strength. As I mentioned there earlier, the S&P 6 straight days of record. So what's the end point, Steve, given we talk about those valuations being stretched?
Well, valuations are quite stretched, and the trades are getting very crowded. But again, momentum and FOMO continue to rule the day. People are seeking risk. The reaction to earnings has been pretty good. Interestingly, though, I ran a bunch of numbers today, and I put them on our website. You can find them at ibkrcampus.com. Interestingly, of the 150 companies that reported in July, S&P 500 companies that reported in July through Friday, more of them were up than down, about 55, 56%. The reaction afterwards, about 80 some odd percent, beat the published estimate, but that's the game that's been going on for ages. So I want to look at how did the companies react afterwards. There you did see an average, more of those companies rose than fell, about 83, I think, or 86 or something like that. I don't have the number right in front of me. But the interesting part is the bigger the company, the worse the post-earnings reaction, more or less. So when I weighted the companies, instead of just saying, here's 150 companies, I then did it by market cap, weighted the reaction by market cap. And actually, the average was actually slightly lower, well below the median. So it was clear that the more scrutinized the company, the more expectations that had been layered onto them, the trickier the reaction. And think about, let's say, Alphabet, which blew away their numbers, and we got a 1% reaction. So that's something that we need to consider as we go into a week with, 4 very major companies. I think they're number 2, 3, 4, and 6 in terms of market cap in the U.S. Reporting this week. How much of that is priced in? Because those stocks really have barely taken a breather.
And I see you also point out that the movement of those meme stocks, which you have commented on in the past, what is driving that, and perhaps, is that coming to an end?
Well, I think the specific meme stock game, fizzled out very quickly. The problem there was the stocks would pretty much hit their peaks about 5 minutes after the open, which was a tell that whoever was goosing these things in the options market the day before, then spreading the social media rumor, then getting the market reaction, then selling right into it. That game ended relatively quickly. But I think what it does tell us is actually much more important. It's that it's emblematic of the amount of risk taking that's going on. I called it a flight to crap in an article that got published last week around when this was happening, and that's probably a bit of an extreme. But what's going on is you just have people willing to take risk. The market, people feel invulnerable, and the comment I made here about that was if you've been playing darts and you've just been throwing darts at the board and everyone comes up bullseye, of course you're going to keep throwing darts and you can't keep doing it more often. And so what's happening is the more risk people are taking, in general, the more risk they're being rewarded for taking. So you're seeing all kinds of very risky behaviors come back, whether it's meme stocks, obviously crypto, but it's not just crypto, it's the crypto treasury companies, where basically your investors are paying a premium for crypto exposure that they could just go out and either buy the crypto or buy a crypto ETF and not have to pay a premium for the privilege, but they're doing it anyway. SPACs are making a comeback, which is, the business model of a SPAC is you give me some money, I'll figure out what to do with it, trust me. That's another one of these signs that there's just a ton of excessive risk taking. There's all sorts of small companies that just flower up on social media and they either work or they don't, and sometimes they're self-fulfilling. More often than not, they just sort of one-hit wonder kind of things. But this is all emblematic of the risk-taking behavior. Question is it excessive? It seems that way, but it can persist for a very long time, even if not. And again, the reactions are very one-sided. I see you have on the banner below, buy the rumor, do nothing on the news. That's kind of what we saw today, where you normally get a bit of a buy the rumor, sell the news, but this was sort of a buy the rumor, do nothing. So the market is looking very one-sided right now regarding risk taking. And again, another thing that I'd put into perspective here is the buy the dip mentality has gotten so strong that the half-life of dips is steadily shrinking. And what that tells me is that nobody wants to miss a buyable dip. So we're actually getting to the point where no one's really willing to sell, because if you're selling, well, then you lose the opportunity to buy the dip potentially. So why sell at all? And that's kind of an interesting little freaky situation we have.
Indeed. Steve, enjoy the big week ahead. Thanks for joining us from Interactive Brokers.
My pleasure, Andrew. Take care.
Let's return to the local market just ahead of the open, and it is expected to be negative. SPI futures down some 0.7%. There's a lot of reports coming to us, particularly production updates from the resources sector. We'll get right across that in just a moment. Stay with us.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.